February 24th, 2026. May end up being remembered as one of those dates that looked ordinary on the surface but quietly marked a structural turning point underneath. If you only glanced at a Western price screen, you would have seen silver trading around $88 per ounce. It moved within a fairly contained range, slightly down from the previous session. Nothing dramatic enough to trigger flashing red banners across financial television. To most casual observers, it looked like a consolidation, calm, routine. But markets are rarely defined by what is obvious. They are defined by what is happening beneath the surface. And today, beneath that calm exterior, the silver market revealed something extraordinary. Two different prices for the same metal operating at the same time in two of the most important financial centers on Earth. While New York traders watched silver fluctuate around the high 80s, the Shanghai Futures Exchange reopened after a 9-day Lunar New Year closure. 9 days offline in a market this volatile is an eternity. When trading resumed, silver in Shanghai did not simply align with the Western quote. It surged. Priced in yuan per kilogram and converted back into dollars per troy ounce, the Shanghai price implied roughly $102 per ounce. That is not a rounding error. That is not a temporary tick. That is a premium in the mid-teens percentage range over the New York price. Same metal, same day, same planet. Two radically different valuations. When you see that kind of divergence, you are not looking at noise, you are looking at stress. Premiums between exchanges do occur. Logistics, taxes, currency movements, and local demand can all create temporary price gaps. But this particular spread has been building for months. Before the holiday break, Shanghai was already trading at a double-digit premium. During the January crash, the premium briefly exploded to more than 30%. And now, even after reopening, the gap remains historically wide. Gold, by comparison, shows only a fractional premium between Shanghai and Western markets. That detail matters. If both gold and silver were mispriced, you could argue that this is a broader precious metals distortion. But the fact that silver ES premium dwarfs gold S suggests something much more specific. This is a silver story. Why would Shanghai price silver so much higher than New York? Start with structure. At the beginning of 2026, China reclassified silver as a strategic material and tightened export licensing. Only a limited number of companies received approval to export refined silver for the current cycle. And China controls a dominant share of the world's silver refining capacity. When the country that refines a majority of global supply places stricter controls on exports, you introduce friction into global flows. Add to that China's enormous domestic appetite for silver. Solar panels, electronics manufacturing, electric vehicles, advanced circuitry, all of these industries require significant silver input. China is not just a major producer, it is also a massive consumer. By prioritizing domestic use, policymakers effectively reduce the volume available to the global market. Then layer in capital controls, import quotas from the People's Bank of China, and value-added tax structures that make cross-border arbitrage far less straightforward than it looks on paper. Even when a price gap appears obvious, regulatory and logistical barriers can prevent traders from simply buying cheap in one location and selling high in another. The result? A structural premium that refuses to close. But price divergence is only one side of the story. The enforcement activity in Shanghai is another. In February alone, the Shanghai Futures Exchange issued multiple notices, suspending or restricting accounts for exceeding intraday position limits in silver contracts. The exchange tightened thresholds in late January, reducing the number of lots that can be opened within a single session. Dozens of accounts have been flagged or restricted in recent weeks. The exchange does not publicly name the accounts involved. Reports circulating in alternative financial circles speculate about Western banks and large institutions being connected to aggressive short positioning. Those claims remain unverified by the exchange itself. What is verified is this: enforcement actions have accelerated at the same time that physical premiums have widened. That is not a trivial coincidence. When an exchange clamps down on position size during a period of widening physical premiums, it signals concern about disorderly trading conditions. Whether the target is domestic speculation or foreign influence, the message is clear. The exchange intends to maintain control over its market. Meanwhile, across the Pacific, a different kind of pressure is building in New York. The COMEX, the primary U.S. futures exchange for silver, tracks two key inventory categories: registered and eligible. Registered silver is available for delivery against futures contracts. Eligible silver meets exchange standards but is not currently designated for delivery. Over the past 4 months, registered inventories have declined sharply, nearly halving from autumn levels. In just one recent week, millions of ounces exited registered status. Over the past month, outflows have significantly exceeded inflows. While eligible holdings remain substantial, they belong to specific owners and are not automatically available to satisfy delivery demands. Now consider the math. The March contract, one of the most active delivery months, carries open interest, representing well over 200 million ounces of silver. Registered inventory sits far below that figure. Even accounting for potential conversions from eligible to registered status, the coverage ratio is tight by historical standards. Does that mean a default is imminent? Not necessarily. The system has tools. Contracts can be rolled forward, cash settlement can be offered, delivery timelines can be adjusted. Analysts at major financial platforms have argued that the probability of outright failure remains low, but stress does not need to become failure to matter. Every time inventory tightens and exchanges rely on procedural flexibility, confidence is tested, and confidence is the invisible backbone of any paper market. Then there is the options market, which is perhaps the loudest signal of all. Implied volatility on major silver ETFs has surged into triple digits on an annualized basis, while realized volatility over the past year sits far lower. That gap tells you traders are pricing in the possibility of extreme moves, up or down, that have not yet materialized in the spot market. In statistical terms, options are bracing for multi-standard deviation events. In plain English, the derivatives market is saying, this calm may not last. Silver lease rates have spiked. Margins have been raised to levels rarely seen outside crisis periods. The spread between futures and spot markets has widened. Historically, these plumbing indicators do not all flash red at once unless something is shifting. And yet, despite all of this tension, the spot price in New York continues to oscillate within a relatively narrow band. That contradiction, explosive stress indicators alongside surface level stability, is precisely what makes this moment so compelling. Zoom out further and the macro backdrop adds fuel. Inflation remains sticky. Growth has slowed. The Federal Reserve is holding rates steady amid internal divisions. Geopolitical tensions are rising. Trade disputes are escalating. The dollar index has weakened over the past year. Major banks have raised long-term gold and silver targets, some projecting levels significantly above current prices. Mining companies are reporting record revenues and extraordinary margins, with all-in sustaining costs far below prevailing silver prices. Yet many analyst models still assume long-term silver prices far lower than today's quote. If those models update, equity valuations could shift rapidly. At the same time, institutional flows into silver ETFs have shown mixed behavior. Retail demand remains strong while some large players take profits. The market is not unanimous, it is divided, and division is where volatility is born. Now, it is important to inject realism into this conversation. Reopenings after holidays often produce exaggerated moves that later normalize. Inventory metrics can look alarming before being resolved through internal transfers. High implied volatility does not guarantee upward explosions. It simply signals the expectation of large movement in either direction. Industrial demand for silver, which represents more than half of global consumption, would soften in a severe recession. History also reminds us that being right about a long-term thesis does not protect you from short-term drawdowns. Silver has proven capable of violent reversals in both directions. Risk management is not optional in markets like this, but what cannot be ignored is the convergence of signals. A persistent double-digit physical premium in Shanghai, accelerating enforcement actions on oversized positions, rapid drawdowns in registered COMEX inventories, open interest multiples above available supply, implied volatility pricing tail risk, rising lease rates and elevated margins, mining margins at record levels, macro instability in currencies and trade. Each of these factors alone might be manageable. Together, they form a pattern. For the first time in modern memory, silver appears to be functioning as two partially disconnected markets, one pricing physical scarcity, the other pricing derivative exposure. Whether those two worlds converge through rising Western prices, falling Eastern premiums, or some combination of both is the critical question. So here's something to think about. If you were holding physical silver in a market consistently paying a double-digit premium, would you rush to sell it at a lower paper price elsewhere? Or would you wait for the discrepancy to resolve in your favor? And if even a modest percentage of March contract holders choose to stand for delivery instead of rolling forward, what message would that send about trust in the futures system? The next several days, heading into First Notice Day, may provide clues. Maybe the system absorbs the pressure once again, maybe premiums compress and volatility fades, or maybe this is the beginning of a repricing phase that resets expectations across exchanges. Markets ultimately answer these questions, not commentators. What is certain is that February 24th, 2026 exposed something rare, a visible fracture line in one of the world's most important commodity markets. Whether that fracture seals over quietly or widens into something far larger is not yet known.